Hey everybody, Economic Ninja here. I hope you're doing well. Just laughing because I was trying to pronounce my guest's name. I'm going to call you Ronnie.
Yeah, Ronnie's fine.
Ronnie,
you did well.
Yeah, thank you so much. Can you please introduce yourself?
Well, I'm Ronnie Stoeferle.
Okay.
I'm an asset manager based in Liechtenstein. Our company is called Incrementum. Many people know us probably for our annual In Gold We Trust report.
Yep.
This is this book on gold, on inflation, on de-dollarization, on mining stocks that we put out every year for 15 years now.
Yeah. But you wrote a book, and that's what we're going to talk about.
Yeah.
What was that book that you read or wrote? You actually wrote a few, so.
I read more than I wrote.
Okay.
I wrote two books so far. I would love to write a third one soon. One was The Zero Rate Trap.
Okay.
And this is where we currently are.
Oh, yes. Yep.
And the second one was called Austrian School for Investors.
That's
Austrian
the one.
Investing between inflation and deflation.
Perfect. So that's what we want to talk today about. What is Austrian economics and why is it so important now? Should you be looking at the glass half full or glass half empty when it comes to economics? So could you do me a favor and explain to everyone what Austrian economics essentially is?
I think we shouldn't do an economic lecture now, but
just a quick
to sum it
overview.
up, I think it is the common sense school.
Yep.
It is the no free lunch school of economics. That's what I
like
would
that.
call it. It is from Austria actually. Karl Menger, then Böhm-Bawerk, afterwards Hayek, Mises, and so on. Were basically the founding fathers of the Austrian School of Economics. Unfortunately, I am from Austria, and everybody thinks it's like the center of Austrian economics. It is not.
Dang! What are we doing here? I'm joking.
But if you go, for example, to former socialist countries, to Poland, I was speaking at a conference there, and it was like totally crowded.
Yeah.
There were like so many young, very ambitious, entrepreneurial people because they know how socialism feels like.
Yes, and that it doesn't work.
Yeah.
It's no free lunch. So let's talk about no free lunch. It's almost weird when you feed the bears don't leave, right? The bears just stick around the park and all of a sudden you got a bunch of bears like, well, homeless people. Today, stronger than ever in our country, we're seeing social programs on a scale that is stronger than I've ever experienced in my life before. And we have a lot of people walking around going, why work? And how does that work in the real economy?
It doesn't work.
Yeah.
So it will probably end pretty badly, and we're coming closer to this end game very quickly.
Yes.
However, I have to admit that the Austrian School of Economics doesn't make it makes assumptions. It doesn't make timely forecasts, and I have to say, I'm guilty because we wrote that book in 2014 or 2015, and we predicted inflation to become a major topic.
Yep.
But we always said there's like 3 stages of inflation. It's based on Murray Rothbard. First, there's monetary inflation.
Yep.
And the Austrian school says inflation is not rising prices. That is just a consequence, but rather an increase of the unbacked money supply.
Okay.
The second stage is asset price inflation.
Yep.
And boy, we
have seen that.
We've seen that.
Yes,
Real estate, equity markets,
Yes.
bond markets, the art market, you name it.
Oh, yeah.
And only the third stage is consumer price inflation, what we're seeing now. So actually, I think the Austrian framework was quite accurate.
Yep.
And as I've said, we're coming closer to this end game, and unfortunately, I'm seeing solutions to the problems that we're facing that are completely the opposite from what I would actually suggest.
You know, you said you have to forgive me because you wrote the book in 2014, and you expected inflation to start rearing its ugly head out of what we saw the Federal Reserve and Europe doing as far as massive printing out after the Lehman Brothers crisis. I completely expected that too, but what we didn't expect is how the Federal Reserve, the Bank of England, World Bank could actually hide money that they were printing by purchasing assets, taking them off the market, and not allowing the velocity of those assets to move. And that's something that really people don't understand. So people like yourself, and I am right there, I'm just as guilty because I didn't expect these swap lines between the United States and Europe and being able to take those assets off the world's markets and be able to hide them. But just recently, we saw the Federal Reserve do something where they started to sell some of those assets in June, and it turned out to be a complete disaster. Can you elaborate on that?
Well, I gave a keynote here at the conference last year, and it was called the monetary tipping point.
Okay.
And I said that COVID really was the tipping point when it comes to inflation. We have seen 40 years of what is called the Great Moderation. So actually, inflation wasn't a big topic at all. It was like studying the snow forecast in the Sahara. Yeah.
Yes.
So for financial market participants in the Western world, yeah, not in emerging markets,
totally,
inflation was like, completely uninteresting.
Yeah.
With COVID, it completely reversed, and my assumption is that 2008 and 2009 we mostly saw obviously. Hi, Jen.
You got heroes.
we primarily saw massive intervention by central banks, reducing interest rates, coming up with something very sophisticated, quantitative easing. Nobody knew what it is. Yeah, it's just an asset swap, and since then, basically, central bankers all over the globe, they complained. Yeah. Well, inflation rates are too low. We can't bring them up. But then with COVID, what really changed was we saw big fiscal stimulus.
Yes.
We saw fiscal stimulus in 2008 and 2009 as well, but much smaller. I think it was 7% of GDP.
Yep.
In 2020, it was 21%. And now we saw direct stimulus. So you actually got the checks
directly to the people.
And this, it's like if you go to the casino and you win, the money that you get, you treat it differently.
I call it monetary heroin.
Yeah,
when it just releases that dopamine in your system, you're like, this is exciting.
So the consequence on the economy and on inflation was much more direct and much faster than quantitative easing, or reduced taxes like in 2008 and 2009. Yes. So we're seeing now with the whole Russia crisis, actually this going direct, it is the new big thing.
Yep.
It is what governments are doing. I think governments really enjoy their position.
Yes.
That they're now really the rulers of the game.
Yep.
And therefore I think, and for some reason, I still listen to the speeches by Federal Reserve representatives that are super boring.
You have to listen to the opposite side of your thesis, right? To make sure you're consistently checking.
I should listen to them because I'm heavily jet lagged. So I woke up at 3 a.m. So perhaps I just should listen to Jay Powell and then I'll fall asleep. But I think we should we should. What's really crucial for financial market participants, we should focus less on what central bankers are saying and doing, and more on what politicians are doing.
Yeah, and it's almost like do the opposite of what they're doing, what they're saying, right? It's everything's fine here, there's nothing to worry about. But actually, in the news just recently, we're seeing that margin calls in Europe to the tune of $1.5 trillion are hitting hedge funds and banks, and there's all kinds of institutions right now being margin called. This is on a scale compared to what happened with the mortgage-backed securities, Lehman Brothers, and all that. It's much bigger, isn't it?
It is much bigger, and I think this is just one side. I mean, being European, it's really frightening. Yeah?
It is.
I think this winter should be fine because they were really buying natural gas at ridiculous prices to fill the storage facilities.
Yep.
But inflation in Europe is another topic than over here, because we've got the very weak euro, obviously. So I expect for the US, I think that over the next couple of weeks we will see that inflation rates will come down at least a bit. And this should give central bankers also some leeway to say, well, we did a great job. We broke inflation. We killed this.
Yeah.
And then, actually to hit the pause button. But obviously, I think, now with this turbo tightening, the strength of the US dollar.
Yep.
The dollar was 92 last year. Now it's 110.
True, but it's weighted heavily to the euro.
Of course, of course. But have a look at the Japanese yen, for example. they are really in the next stage of the monetary endgame.
Yeah, basket case 2.0.
Yeah.
Yes.
So
totally.
I think they did like 15 rounds of QE, and so far it didn't really work too well. So the strength in the US dollar, then you've got quantitative tightening kicking in September with 95 billion per month, and then you've got very aggressive rate hikes. Yeah. So this is like the perfect recipe for a crash.
Now, what I want to ask is, you probably had a bunch of people on the edge of their seat just a second ago when you said you believe that you're going to see inflation numbers start to come down a little bit in the next few months, a couple months. Do you believe that is because of direct intervention from central banks, or do you believe that this could be disinflation or deflation because people, the man and wife at home that are paying higher energy bills, higher food costs, things like that, they're contracting their spending, so that would actually cause companies to actually lower prices or become more aggressive in their marketing to be able to try and sell their goods? So what do you think about that?
Well, if you have a look at financial markets at the moment, it's screaming a recession. Have a look at commodities.
Yes, we are in a recession right now. I don't care what the president tells you.
Especially the ones that are very, very sensitive to the economic cycle.
Yes.
Then obviously we are seeing that in this market, the higher the debt levels, the higher the sensitivity to rising rates. And just 1 year ago, rates were at 0.
Yeah.
Now we are talking about 4% at the end of the year. Mortgage rates have more than doubled. So
they're going even higher.
So I mean, you don't have to be it helps to have a view of the Austrian School of Economics, definitely in this environment. But I think if you've got common sense, then it's pretty obvious that this will not end well. And the thing is, I think that many market participants are quite disappointed and fed up when it comes to gold.
Yeah.
Actually, we're seeing this bust of this everything bull market.
Yes.
So we're basically in an everything bear market.
Yes.
Everything is down.
Yeah.
Commodities, equities, the bond market.
True, unless you price gold, you start from January of 2020 till now, gold has done very well as far as other asset classes. Even if they're off the tops of this last January, they've really held their weight, right?
I mean for us in Europe, plus 9% in euro terms,
That's so true. So let's close on this. What is your outlook on gold over the next year with all the craziness that's happening in the world?
Well, I think, we're clearly seeing that fiscal policy is becoming more and more important, and I don't see any return to fiscal how do you call it, like a sound fiscal policy.
Common sense is not so common.
I just don't see it.
No.
There's a lot of morons out there. And obviously we are in a recession in Europe. We are in a recession probably in the US, although I have to say the US is doing much better than Europe. China is not doing so well. So we are in a tough environment, and I think it would really be naive, and I cannot believe why people think that there's now really hawkish guys and girls sitting in the central banks that really want to change something. So at some point, obviously, we will see this U-turn. But this is the trap that central bankers are in. I mean, you cannot make this brutal U-turn like in 2018, which was, I think, just 6 weeks when inflation is at 8%.
Exactly.
So I think that's one of our main calls. Fiscal policy will become much more important. When it comes to gold, I think as soon as they hit the pause button, I think gold should put in a bottom at least. And I think once they really start getting going again, and once we return to some sort of a risk-on policy or risk-on behavior again, I think that gold will probably be the first and silver second to start rising.
I agree.
Like we saw in 2009, for example. So actually, I think gold has done okay. It's not super exciting, but let's face it, we've been close to all-time highs this year already. We've made plenty of new all-time highs in euro, in Japanese yen terms, and so on. My only concern is that if we see some sort of a super spike in the US dollar, up to 120 or whatever.
And it can do that. It did that in 2003.
Definitely, it can happen. This is gonna be really tough for emerging markets.
Yep.
This is going to be, and we're already seeing very, very concerning news coming out from emerging markets, from Africa, but also from Asia, where people just cannot afford
Totally.
food anymore. And this is something that besides all the financial market stuff, if people just cannot afford buying rice, wheat, whatever, that's something that's very, very concerning.
It is. You know, and that's what's tough, because we keep talking about gold and people immediately look at the spot price, but they don't look at the premiums that are exploding on physical gold, because that physical market, and like you said, as emerging markets get tighter, there may be some emerging markets that start going to grab physical and take it off the market. So that would even increase premiums even more over time, right?
Absolutely. And for the time being, I think the commitment of Traders report, it's not for me, it's not decisive, but I think to understand where we are in the cycle,
Yep.
I think the commitment of Traders report for gold and especially for silver is excellent. So actually it is like, if there's, we were on vacation with a friend of mine, and he's from Italy, and he was cooking all the time. And
now you're making me hungry. Thanks.
And he was cooking all the time.
Yeah.
But once he said a tavola, so come to the table.
Yeah.
Everybody was getting really, really excited. So I think, you know, with this analogy, I think everything is prepared for precious metals.
Yes.
But nobody rang the bell and said a tavola.
Yep.
Yet.
That's a really good analogy. I like that. Yeah. Well, hey, let's do this. I wanted to bring you onto the channel because I want my subscribers to be able to hear from successful people in the space. You obviously run a hedge fund or a fund manager. I apologize. Yeah. Can you tell them how they can find you or your book again? What? Let them know.
Well, our webpage is incrementum.li. We're an asset manager based in Liechtenstein, one of the smallest countries.
Which you've told me is the most boring country ever.
I would say it's conservative. It's great to make business. Yeah. If you want to have fun, go to Vegas. But if you want to
see castles. That's what I want to go for.
No, it's a lovely place and very, 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 very nice scenery.
Nice.
And we're a boutique asset manager managing 6 investment funds, managing money for high net worth individuals. And then we've got the In Gold We Trust report that we put out every year, totally for free. You can download it. You don't have to subscribe for anything. It's ingoldwetrust.report. We had like 2 million viewers for the last edition. We publish in German, English, Mandarin, and also in Spanish.
Wow.
So, yeah.
Go take a look at that, guys, the gold report. And then it's every year, right? This is just a hard copy.
Yes.
Awesome. Well, thank you so much. I really appreciate you coming on, seriously.
Appreciate it.
All right, guys, with that being said, the Economic Ninja is out.